5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to another episode of the Follow the Money podcast. I'm your host, Jerry Robinson, and today we're going to be talking about swing trading. You know, swing trading can be one of the most exciting and rewarding ways to trade the markets. It's all about capturing those short to medium term moves in the stock market or the crypto market, or really any asset that has enough volatility to give you those profit opportunities. But as many of you know, and those of you who are seasoned traders out there, swing trading is not just about technical analysis. It's not just about how to read a chart. It's really about mastering your mindset, because at the end of the day, how you think will ultimately determine how you trade. And so in today's very first segment, we're going to be focusing upon what I call the swing trader's mindset. We're going to be sharing some psychological tips for market success for those who are specifically swing traders. I'll be sharing some essential psychological tools and techniques that can help you stay sharp, disciplined, and ready to capitalize on the market swings without letting emotions get in the way. So it doesn't matter if you're a beginner out there or a seasoned trader. I'm going to share some basic tips that are designed to help you navigate the mental challenges now of swing trading. And I want you to be able to do it with confidence and clarity. So we're going to focus on that in segment 1. Now, later in the show, in segment 2, I'm going to be updating you on some of the latest market moves. We've obviously had some wild moves in the market lately. We're going to talk about the S&P 500 and the Nasdaq 100. We'll look at some precious metals like gold and silver. We'll also check in on Bitcoin and Ethereum. And then, as always, I'll wrap up with some concluding thoughts in segment 3, leave you with some powerful thoughts to help you stay motivated and to stay on track. So with all that said, let's dive right in. All right, friends, let's jump right into today's very special topic, the swing trader's mindset. Now, if you've been trading for any length of time, you already know that psychology plays a major role in trading success. It's really the only way you're going to succeed long term is you've got to get your mind set correct, right? And it's often the most overlooked aspect, especially for those who are just getting started. When I mentor new traders, they're often very focused, as you would fully expect, upon the price and the price action and understanding the charts and understanding volume and understanding how stocks and cryptos move or whatever they're trading. It's all understandable. But what I can tell you from many, many years of not just trading, but also coaching other traders, is that most traders, especially when they're new, they underestimate how important psychology is. And so today I want to highlight just a few psychological principles that can make or break your trading career, right? It's really quite true that the psychology that you have and what that you bring to the table when you're trading can really make or break your future success. So let's talk about some of these. Let's begin with first, emotional discipline, right? The first thing we need to talk about. So swing trading, by its nature, involves holding a position, whether it be in the stock market, the crypto market, the bond market, the currency market, whatever you're trading. You're holding it for a period of days, sometimes weeks, but I usually think of swing trading as, holding a stock for anywhere between 1 and 10 days. Sometimes you go a little longer, but usually 1 to 10 days. And my aim or my goal is to earn 1 to 10% with each trading idea. And here at followthemoney.com, we put out one daily swing trading idea to all of our members. Every single day, all of our members get an email. And in that email, we provide a swing trading idea, a swing trading entry price, which we call the trigger price, and then also a suggested stop loss price. And you can follow along with these trading ideas each and every day right here as a Follow the Money member. So we put out these trading ideas every day, and our goal for each of these ideas is 1 to 10% within 1 to 10 days, right? So that's how we view swing trading. Well, Swing trading is all about those small, short holding times. But while you're holding that position, while you're doing that, you're going to find that the market is going to test your resolve. Right? You're going to see your positions fluctuate as a swing trader, sometimes wildly. And this is where emotional discipline becomes crucial. So when the market moves against you, the instinctive reaction is fear of losing money, fear of being wrong. And then on the flip side, when your trade is going well, there's the temptation to get greedy and to hold the trade too long, right? Hoping for even bigger gains. Well, both of these emotions, fear and greed, are the enemies of disciplined trading. So the key here is to have a solid trading plan and to stick to it no matter what. Many of you who've been following us for some time know that we teach the extreme importance of treating trading like a business. So you would never start a business without any clue of what your focus is, what your niche is, what you're trying to do, what your target audience is. Same thing when it comes to trading. Many people just think it's so easy. They'll just jump into it and think, I don't need to learn anything. I'll just trade this stock that I heard about from my coworker, or I'll just trade this stock I heard about from my uncle or whatever. And then things don't work out. And they say, well, trading doesn't work. Well, of course it doesn't work if you don't actually have a plan. It's the same thing with business. I mean, business doesn't work if you don't have a plan. So you can't just say trading doesn't work if you don't have a plan, right? So the key here is that if you want to have emotional discipline, you've really got to create a trading plan and then stick to it no matter what. You need to have entry and exit points set out, charted out before you place the trade, right? So you don't let your emotions talk you out of a good trading idea or into a bad trading idea. Remember, the market doesn't care about your feelings. It's indifferent to whether you make money or lose money. It doesn't matter to the market. Your job is to stay disciplined and to stick to your strategy so that you can succeed in the long term. Obviously, I could go on about discipline for a long time. It's one of the fundamental key strategies for success in the markets, whether you're a day trader, a swing trader, position trader, any kind of trend trader for that matter. And even if you're just a long-term investor, you still got to have discipline, right? Your job is to stay disciplined and to stick to your strategy. Okay, well, that's the first point. Emotional discipline, vital. The second point I want to bring up today, and when it comes to the swing traders mindset in particular, is stress management. Okay, so the shorter time frame that you're trading, the higher the stress. And I've learned this over time because I began my own trading career as a day trader back in the mid-1990s. And then over time, I learned to trade options, and then I started moving into swing trading, which is what we're talking about today. Day trading and swing trading are two very different types of trading. Day trading is where you're in and out in the same day. And that can be extremely stressful, especially when you do it day after day after day after day, because you're stuck in front of a screen and you're always having your money on the line all the time. It can be very, very draining emotionally and just create a lot of stress in your life. Well, swing trading is the second most stressful out of all the different trading that I've done over the years, the types of styles of trading. Swing trading is the second most stressful. Not as stressful as day trading, but not as easy per se or as simplistic as position trading is. And position trading still requires a lot. But on the stress level, position traders will trade and they will hold for a period of months, usually many, many weeks or often months, sometimes even a couple of years. So today I really focus more on position trading because of my lifestyle. But I still put out swing trading ideas all the time because I like the idea of swing trading and it's a great way to create extra income in your own life. So we're talking about managing stress here when it comes to swing trading. And as I mentioned, swing trading can be stressful, especially when the market gets volatile. That's when it really can become a bit more stressful. You're constantly monitoring your positions. You're trying to time the market. It can take a lot of toll on your mental well-being, especially if you're trying to run a business or if you are also working for a living and you're trying to fit this into your life. It can be very stressful. So one of the best ways to manage stress is to have a routine where you have office hours when it comes to trading, and then you also have breaks. It's important to get away from the screen. And that's what I like about swing trading versus day trading. Is day trading, you're really shackled to a screen. I mean, quite frankly, if you walk away from the screen when you're day trading, you better be careful, right? Obviously, you're using stop losses. It's not like you're going to, you could always get stopped out. But the point is, you really want to be vigilant when you're day trading. With swing trading, you get a bit more relaxation there. You can get away from the screen a little bit, right? It's not a big deal. You can place your trade and go to work, set your stop loss, and check it out later. But the main thing here is that even those who are swing trading can get hyper focused upon their computer screens, and they can get really stressed out, bent over the screen, looking at things, not taking their eyes away from the screen, just really getting stressed out. And so it's important, to clear your mind, get some fresh air. One of the things that, that often happens when you get stressed out is you start over trading. That's a common mistake that people will do, is they will just get so hyper-focused that they'll start over-trading. They'll be trading too much. They'll revenge trade. Maybe they'll lose and they'll try to get back at the market, and then they end up losing more. And all that can lead to burnout. So you really want to focus not on over-trading, but you want to focus on quality trades, not quantity. And that's something that new traders just simply have to learn the hard way. You don't have to, trade everything that moves. You really want those good setups to come to you, and you want to wait for them. And so sometimes being patient is what you got to do, and that can help in terms of stress management, because it's often the impatience that leads us to an area of great stress. Not always, but often it can be. And remember, stress often comes from feeling out of control. So you feel like, you're not really meeting the mark. Maybe you feel like, you're on a losing streak, and that can raise your stress. But you can regain control by focusing on the process, not the outcome. Right? You can't control the market, but you can control how you react to it. One of the things that I encourage all traders to do, especially those who are day trading, swing trading, one of the best things you can do for your life overall, not just as a trader, but anything, is exercise. One of the things I did early on was get myself a sauna. I have a sauna in my house, and I've often talked about that, how important it is to me that having that sauna, it's great for stress relief. I can go in there, I can turn off the world. I can sit there in the dark, and I can just think, I can meditate. I can, I can pray. I can do all kinds of things in the sauna, and the sauna gives me that chance to kind of reset. And it's a great place. Obviously, it's good for your health as well. So you have to find those things that really calm you, and you want to manage that stress. Don't let stress get out of control. It'll affect your trading. And many traders out there know that, so they know the importance of stress management. But if you're new, I got to stress that to you, that you really do want to have a routine that includes breaks. Don't overtrade. Don't get caught up in the revenge trading kind of idea, but instead really create some stress management techniques that work for you so that you can stay in a good place mentally while you're trading. Okay. The third point that I want to bring up today when we're talking about these psychological tips for swing traders is the importance of confidence without overconfidence. Now, this is a tough one here. See, confidence is critical in swing trading. If you don't believe in your strategy, if you don't believe in your trading plan, well, you're going to second guess every move that you make, and that's going to lead to missed opportunities and losses. So there's a fine line between being confident and being overconfident. Confidence comes from preparation. It means you've done your homework, you understand market conditions, you're executing on your plan. But overconfidence, on the other hand, can lead to reckless trading. It cause you to ignore your risk management rules, right? You may not be using stop losses because you're so overconfident that you're going to knock it out of the park, or you're going to, and you may have unrealistic expectations from a trade also that overconfidence can create. You may take on positions that are too large. You may be trading without a plan. You may be not trading with a stop loss in place. You may be trading things that you have no business trading because you just heard about it from someone online or whatever. Again, confidence without overconfidence is huge when it comes to trading. So to maintain the right level of confidence, what you want to do is you want to have that trading plan in place, and you want to review your trades, both the winners and the losers, and learn from them and use that knowledge to build a solid foundation for future trades. I remember whenever I was first learning trade, I remember a specific memory back in 1998 where I had made I had a really good day. I think it was my very first $1,000 day in the trading, as a trader, as a day trader. And that was my big goal. At first I was like, let me make $100 a day. I thought that was really cool. And I would take off of work because I was working as in corporate America, and I was learning to trade, and I would take off. I would call in, I would say, I'm sick. And it was terrible. And then I would stay home and I would trade. I would day trade. And, sometimes I wouldn't make any money. Sometimes I'd lose money. But my goal was always, $100 a day. That's what I was trying to do. I said, if I could just do $100 a day, this would be great. And then over time, I was like, okay, now I can do it $200 a day. Well, anyway, ultimately, my goal became I wanted to have $1,000 day. And I didn't have a huge balance to start with. So I wasn't like dealing with, tens of thousands of dollars. I was trading a small balance, as most new traders probably do. And I remember it was 1998, and I had I believe it was my very first $1,000 day as a day trader. And I was so pumped. Called all my friends. I wanted to take everybody out for a steak dinner. I was just pumped. I was thumping my chest. I thought I was, King Kong. And went out, and did that, kind of celebrated, had my thing, came back the next day all overconfident and practically lost it all. Right? Have you ever been there? Have you ever been? I mean, it's a real story that I still remember to this day, and it still stings. And I remember the overconfidence I felt after having that $1,000 day. Watch out for those big days that you don't get wrapped up in it. Today, you fast forward to where I am today. That was back in 1998. Here 25 years later, practically. Whenever I have a good day in the markets, you'll never be able to tell. And if I have a bad day, you'll never be able to tell from my face or from the way I walk or from what I say, because I've learned that you cannot be fazed by what's happening in the markets. If you have a great day, great. If you have a bad day, that's okay. That's part and parcel of being a trader. The key is to not be moved emotionally by every single one of those things. So that takes time. When you're a new trader, you're just going to be, you're going to be pretty enthused on your big days, and you're going to be pretty depressed on your bad days. And the point is you got to learn not to take it personally, that it's just business. And over time, you'll learn that. But it's not going to come easy, and it's not going to come without some pain. You're going to have to learn to have confidence without being overly confident, and to keep that emotional discipline in place. Let's move on to the fourth concept here. And I got about 5 of these for this first segment. I want to talk about these psychological tips here. The fourth tip here is how to cope with losses, right? You're going to lose money. This is what many traders just don't seem to understand when they're new. Let's be real. Losses are a part of trading, right? No trader wins 100% of the time. And if anyone tells you they do, they are absolutely lying to you, or they're not really trading, one of the two. Because the important thing is not whether you're going to lose money or going to make money. That's obviously going to happen. What the important thing is how you handle those losses, right? A common mistake is to let a losing trade affect your next trade, right? I've seen this so many times. It affected me early on. What will happen, and this is what would happen to me, is I would start trading emotionally. So maybe I would lose on a trade. It kind of cut my way, kind of made me angry. I thought it was going to go up, and then it starts coming down, and it hits my stop loss, and I lose money, and I'm starting to feel emotional, and I'm going to try to win that money back. I'm going to win back what I lost. And then you go back in, and then you try to catch that falling knife, and you lose again, right? It leads to more losses, right? So this is known as revenge trading. And it is a sure path to blow up your account. I mean, if you want to blow up your account as a trader, just revenge trade. Just keep trading and putting good money after bad. Every time you lose on a stock, go back and trade that stock again and try to get it back, right? And you're going to find that you will just continue to blow up your account. The best way to cope with losses is A, to have a stop loss in place and have a risk management rules that you live by. And to B, just accept the fact that you're going to lose in the market, right? Analyze what went wrong, learn from it, and move on. Don't dwell on it. Remember, every trade is independent of the last one. And the thing that you want to keep in mind here is that even the very best traders that are out there only have a win rate of about 60%, which means that, you're not going to have 8 or 9 trades out of 10 go your way. I mean, you may get lucky and have a streak, but that's just what it is. You're not going to see that consistently. Not even the best traders do. The best traders know they're going to lose, and then sometimes they even lose more than half the time, but they keep their losses limited and they let their winners run. So they don't even need to have more than 5 out of 10 win if they keep their losses low and if they let their winners run. But the truth is, the good traders out there, about 6 times out of 10, they're going to win. And by using good risk management rules, that actually is all you need to be a success. So don't think yourself to be a loser because you lose money in the market from a trade. That is just how it works. If you can't handle losing in the market, you might as well get out of it because that's just part of it, right? So you got to learn to cope with losses and simply accept them as a normal part of trading. What you want to do is manage those losses through the use of stop losses. Stop loss orders are vital. We've done teachings on those many times for our members. We have all kinds of teachings on those. We've even talked about them on podcast episodes in the past. Okay, so that's the fourth tip here for you psychologically for those swing traders, that swing traders mindset. Now, let's finally talk about the fifth and final point here I want to bring up in segment one, and that is the power of routine. Right? Power of routine, having a daily trading routine or a weekly trading routine. That can bring some sense of order and control to your trading. It helps you stay focused and helps you stay disciplined. So your routine might include, pre-market analysis or reviewing the news or checking charts or setting your trading plan for that day. And after the market closes, you might take time to review those trades and analyze what went wrong or right, and then plan for the next day. You just need a routine, and you need those office hours where you're protecting your time. And the important thing is that you want to, obviously, if you have a family, for example, and you're working for a living, and then you're coming home and trading, well, you've got to make sure that you're leaving time for your family, right? In other words, you've got to, because that's going to create even more stress if you're alienating your family in the process of trying to trade, right? So again, it's very important that you learn to that family life balance so that you'll stay in a place where you're not stressed out from that situation. But a solid routine can help you stay consistent, and it's key to a long-term success in swing trading. So the power of routine, creating a routine, creating office hours. Where do you trade? Do you have a special place in your house or your office where you do that? Do you have a certain time that you do that? Does your family or friends know that's what you're doing? Are they supportive of you in that? That's another thing too that many people will end up in, is they'll get excited about trading, and they may want that same excitement to come from their friends or family, and the friends or family may not have any clue what they're doing. They may not even know what it is, and they may try to talk them out of it, or they may try to tell them that you can't succeed at that, you're not any good at that. So you got to be careful about who you tell what you're doing, because again, you don't want others to deflate your psychology, because they can talk you out of trying to improve yourself. So you got to be careful about that as well. So the power of routine, very, very important. Have that daily or weekly trading routine, have it set in stone, and just stick by your rules. So there you have it. 5 psychological tips to help you develop the mindset of a successful swing trader, right? We talked about the importance of emotional discipline, stress management, how to be confident without being overly confident, how to cope with those losses, and also the importance of having a routine. Remember, mastering the mental game is just as important as mastering the charts and the indicators, if not more. With the right mindset, you'll be better equipped to navigate the ups and downs in the markets and come out ahead. All right, so stick around, and up next, we're going to be diving into our market update. I'm going to cover many of the latest moves in the stock market, the crypto market, and more, so don't go anywhere. We'll be right back.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to the Follow the Money podcast, one of the longest running podcasts dedicated to your personal finances that you'll find online. Now, we move into segment 2, and what we want to do here is we want to provide a nice market update. We've seen a lot of things happening and just transpiring over the last couple of months. It's been quite historic. We had that volatility spike, which was not necessarily historic, but the rally back from the volatility spike we had on August the 5th was simply historical. I mean, it was pretty amazing to see that incredible rally, that V-shaped rally that we experienced in the market after that early August swoon, after that volatility has soared. So anyway, as we look at the S&P 500, for example, the most important index here in the United States, we see here that it's trading just below its all-time highs. The all-time high on the S&P is around 5670 or so, somewhere in there. We're currently trading as of this Wednesday, it's August the 28th here, as I speak. I'm looking here at the chart of the S&P, and it's trading just around 5,600. So we are literally just like 1 to 2% below an all-time high on the S&P 500. Now, we've worked our way back up there after that swoon that we had. Right now, if you look at the S&P 500, you'll see about 3 out of 4 of the stocks in the index are trading above their 200-day moving average. That's bullish. That suggests bullish, what we call market breadth. So that looks good. But now, as we head into the remainder of this week, Thursday in particular is very likely to be a big day for the market. Why is that? Well, because on Wednesday, after the close, that is the day I'm recording this, after today's close, we're going to get the earnings report from NVIDIA. And NVIDIA, of course, is a very, very important stock to the stock market. In full disclosure, we own NVIDIA for the long term in our long-term investment portfolio, but it's really the only game in town when it comes to artificial intelligence and GPUs, right? It really is. It's really the primary beneficiary here of this AI boom. And when we look at analyst expectations, many are expecting a strong beat and strong guidance as we head into the remainder of the year. The consensus estimates for NVIDIA are around 64 cents per share in earnings and about $28.5 billion in revenues. So we'll see what happens. There was that concern about the Blackwell GPU delays that are pushing out some of the revenue upside from Blackwell. We've seen many of the customers of NVIDIA have been settling to buy, more of the H200s, some of the different GPUs that are available before the Blackwell GPUs that come out. So that is also a concern. Investors are going to be really listening closely to the guidance on that, and also any expectations on when those Blackwell GPUs, the next one, is going to be available for buyers. We also had many other earnings this week, and we also got note from Apple that they have an iPhone event coming. The September 9th is the next iPhone launch event, scheduled for September the 9th. Apple typically hosts its product events in the month of September. And so now we know that, the date that this is going to happen. We're going to get those new AI updates for the iPhone 15, the iPhone 15 Pro, Pro Max, and the future models. You're going to have at least an Apple 15 to be able to have access to Apple Intelligence and all of the new AI tools. And so that should be driving an upgrade cycle for the iPhone, which is good news, I think, for Apple. And in full disclosure, we also own Apple in our long-term portfolio for the long term. Now, turning to the Nasdaq 100, which is obviously affected by Apple and by NVIDIA, we've been seeing it also. That's my specialty. That's the index that I follow the most as far as my own personal finances. I like the Nasdaq 100. That's my personal niche in trading, but also in investing. I like the tech space. I like the crypto space, as many of you know. Well, as we can see here, QQQ, which is the Nasdaq 100 ETF put out by Invesco, is trading right at its 50-day moving average after bouncing from the 200-day support back on August 5th on that big volatility spike. Well, right now we're hanging out right around 470 on QQQ, sitting right there at that 50-day moving average, but we're still trading just below the recent all-time high, which was set back in early July when it was around $500 or so, just slightly above 500. So we expect that we will see another breakout to a new fresh high for QQQ and for the S&P as we head into the remainder of this year. When we turn to something like gold, gold just continues to power to new record highs. Gold has surpassed, of course, silver in that way. Silver is still trading 40% or so below its 2011 peak of around $50. But when you look at gold, gold's never been more expensive, or never been this price. It's never been above $2,500. And now we're sitting, above $2,500 per ounce on physical gold. What does that tell us? That tells us that there is still quite a bit of uncertainty in this economy, and there's a cognizance that neither political party is dealing with the debt situation, the underlying debt problems here in the United States. We do think that gold has had a very nice rally this year. We did expect the rally. We told our members in our 2024 outlook that we put out for the market back in January that we expected gold and silver to do well as Bitcoin and Ethereum. We'll talk about those in a minute. But gold overall, we think has had a very good run. And while we think there's still more upside ahead, we think that the greatest gains in gold for this particular cycle have likely been made. We think there'll be a catch-up trade in silver. And we see, gold hitting, 2,700 or so, maybe 2,750, before, we start to see a general pullback there before we might go higher. No reason why we couldn't see gold hit 3,000 or even higher. But we've had just such a nice, strong run since the June lows that we really are due for a pullback of some kind. Of course, we're getting a nice push higher by the dollar, which the dollar, of course, has fallen sharply as expectations of the rate cut are really accelerating. Last week, we heard from Federal Reserve Chair Jerome Powell when he was speaking at the Jackson Hole Summit, and he strongly hinted at upcoming interest rate cuts to counter the weakening U.S. labor market at the September meeting. We also saw on the Fed minutes that not many, but some of the Fed governors were already ready to cut back in July, right? So in essence, we know that the rate cut is coming in September. It's obvious. We've been expecting this, and that is going to further pressure the U.S. dollar down. We can see the dollar continuing to fall, which is going to boost things like gold, like silver, like equities, and even things like cryptocurrencies. One other index that we like to follow in the stock market is the Russell 2000, the small cap index. While I don't own that index, I do expect it to do well by the end of the year. Small cap stocks are very dependent upon or very sensitive to rate cuts and rates in general. And so when you cut rates, small caps are often some of the primary beneficiaries of that. And so we do expect small caps to do well throughout this year. We're watching, in particular, IWM, the Russell 2000 ETF. And if we get a breakout above 225 on that particular ETF, we think we'll probably be off to the races there for IWM. Big support there on IWM around the 190 area, by the way, 195 or so, right at there at that 200-day moving average. Now, we can also consider something like silver. Silver is trading right around the $30 level right now, and it's come back up. Now, it recently peaked out in May around 32.75, but it's pulled back from those peaks, and it came all the way back down to the 26.50 support level. But now it's hovering right around the $30 level. So we aren't too terribly far away, maybe a little less than 10% away from hitting a new 2024 high in silver. And we think silver has more room to the upside. More than gold, for example, in this cycle. We think gold has really kind of been in the pole position there. It's really enjoyed the big gains. Silver has also, and this year they're pretty much evenly matched in terms of gains, but silver is still, trailing gold in overall gains, and certainly not trading at a new all-time high like gold is. But silver is in a multi-year breakout environment. It has been for many, many months since we called that around the $25 level. So silver, we think, still has plenty more upside ahead. It's just going to be, one step forward, two steps back right now, while the economy is still trying to figure out, what's going to happen in terms of rate cuts and whether the soft landing and all of this. So there's a lot of uncertainty still kind of lingering in the market. Now, I also want to briefly talk about cryptocurrencies as well. Many of you follow cryptocurrencies like we do. We've been talking about Bitcoin right here on this broadcast for well over a decade. I would imagine we were one of the very first podcasts to ever bring up Bitcoin, for that matter. Talking about it back in 2012 and 2013, it was pretty unheard of to be talking about those kinds of things back then. Well, we're still talking about it. We're still talking about Bitcoin and still following Bitcoin and still buying Bitcoin. And right now, Bitcoin is really kind of gyrating around a rising 200-day moving average. We got a fake out breakout the other day when we got right above the 200-day moving average. And then we stayed there for a couple of days, and then we came right back down below it. So right now, Bitcoin trading at about $59,000. That's the upper edge of the support range we're watching. 50 to 59,000, that range there has been holding very nice. We expect that's going to be the floor here for this particular cycle. We think that we're going to obviously see more gains as we move into the remainder of the year. I was just telling our members on our private coaching call that we do, our Trends and Profits webcast, I was just telling them that I expect that Bitcoin is going to break out to the upside and establish a new high sometime within the next 60 days based upon our analysis. We could be wrong on that, but that's what we expect. We expect the big cycle to be fully clear based upon the chart, and a breakout to be confirmed sometime within the next 60 days, likely in the month of September, but certainly we would expect by the month of October, we'll see Bitcoin really beginning to break out, set those new highs, and start catching the attention of investors. Right now, it's still grinding sideways in a really tight pattern that's been playing out since it peaked, back earlier this year. So we've had a long, lengthy consolidation period, months and months, and we think that's going to lead to a nice breakout here relatively soon. Also, Ethereum, which recently had its own ETF released, is also trading just above its major support area that begins around the $2,400 level. It's currently trading at about $2,500. That's well below its $4,000 peak that was reached earlier this year. So it's definitely trading well below its former peak this year. And again, we expect more upside for Ethereum. We think there's more upside coming for that particular crypto. There are several other cryptos that we follow, that we own, that we like, and we think are going to do very well in the in the months ahead, especially over the next 12 months or so. If you are not a member here at Follow the Money, you're just missing out. We have daily swing trading ideas we put out every single day through email to all of our members that are profitable, right? Profitable swing trading ideas. We tell you the stock we're looking at. We tell you the price. We like the trigger price, the entry price. We tell you what the stop loss is we're looking for. We tell you why we're bullish on the trade, and it comes out to you every day. And then if you're looking at cryptos, well, we tell you what we're buying there as well. And we have a long track record with cryptocurrencies and with trading. All that's available for our members. You can go to followthemoney.com/join, and there you can see our plans and pricing. Become a member. Check it out. There's no requirement for you to stick around. You can try it out. And if you're not happy, not satisfied, get your money back. There's nothing to lose here at followthemoney.com. We're simply here to help. We have a long track record of helping people just like you make money in these markets. Don't miss out with the markets going higher. Learn to earn. Let us help you right here at followthemoney.com. All right, friends, welcome back to the final moments of today's broadcast. And we have covered a lot of ground today. We've talked about mastering the psychological keys to swing trading. We've talked about some of the latest market moves here across some of the major financial markets like the S&P and the Nasdaq and the Russell 2000 and Bitcoin and gold and silver and Ethereum. And there's no doubt that we're in an environment today where staying sharp and informed is more crucial than ever. And as you think back on everything we've discussed today, remember this. Successful trading, whether we're talking about swing trading or day trading or position trading or anything in between, isn't just about reading charts or staying on top of the latest market news. It's about you. It's about your mindset. It's about your discipline. It's about you. It's about your ability to stick to your plan even when the markets throw you a curveball. Now, we all know that the markets are unpredictable. They can be full of highs and full of lows and everything in between. But the traders who come out ahead are the ones who keep their emotions in check and who stick to their trading plan, stick to their strategy. And they learn from experience, whether it's a win or a loss. And that's the mindset that I want you to embrace. Now, before we close today's episode, I want to leave you with a thought from the legendary financier, very well known back in the 20th century, Bernard Baruch. He said, "In trading, it's not about how much you make, but how much you don't lose." Now, this quote perfectly encapsulates the importance of risk management in trading. It's not just about chasing the gains. It's about protecting your capital and making smart, calculated decisions. And by focusing upon minimizing your losses, you give yourself a much stronger foundation for long-term success. So for all of you swing traders out there, and as you continue your trading journey, keep this wisdom in mind. Stay disciplined, stay focused, and remember that sometimes the best move is the one you don't make. And that's all for today's episode. If you enjoyed the show, please don't forget to subscribe and share the podcast with others and leave us a review on iTunes or any of the places that you like to visit for downloading podcasts. And as always, remember, when you want the truth, just follow the money. Have a safe and prosperous week, and we'll look forward to seeing you right back here next time. God bless.
Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any